Hello guys, welcome back to PrizeDr's YouTube channel, where we talk about anything to do with finance while simultaneously plugging our site. Today's video is going to give you the know-how behind how Warren Buffett invests, his philosophies when he picks stocks to invest in, and why you should follow his guidance if you want to. Remember, this is not financial advice, so do your own due diligence before you make a decision regarding your financial position. Warren Buffett is a household name for private investors and institutions alike, and have long praised his ability to pick which stocks you should invest in. He consistently follows value investing principles, which has netted Buffett a net worth of over $100.6 billion as of April 2021, according to Forbes at least. He resists the temptations associated with investing in the next big thing, such as the neo boom that happened recently. He has an uncanny ability to uncover long-term profitable investments, which is why it's understandable most investors would like to know exactly what Warren Buffett looks for in a stock. We'll try to show his thought processes in this video. Warren Buffett belongs to the value investing school, popularized by Benjamin Graham. Value investing looks at the intrinsic value of a share rather than focusing on technical indicators such as volume or momentum indications. Determining intrinsic value is an exercise in understanding a company's financials, especially official documents such as earnings and income statements. Starting off, Warren Buffett looks at how much debt a company has. Having a large ratio of debt to equity should raise a red flag because more of a company's earnings are going to go towards servicing debt, especially if growth is only coming from adding on more debt. Instead, Buffett prefers earnings growth to come from shareholders' equity. A company with positive shareholders' equity means the company generates enough cash flow to cover its liabilities and is not relying on debt to keep it afloat. For Buffett, low debt and strong shareholders' equity are two key components for successful stock picking. Then he looks for companies that have a good profit margin, especially if the profit margins are growing year on year, indicating very healthy growth. Bear in mind you need to examine the profit margin over several years to discount short-term trends that may have affected those results. To stay on Buffett's radar, a company's management should be adept at growing their profit margins year over year, a sign that management is also good at controlling operating costs. Then he has to consider whether the companies produce products that can be easily substituted for other companies that provide more unique offerings. For example, a phone case company's product, phone cases, is not all that unique because you can buy phone cases from any number of other competitors. However, if the company has brand recognition behind it, then that might be an investment worth looking at. In this case, the company's brand name could be a competitive advantage that helps it earn profits through greater sales and margins. He also employs quite a radical approach to narrowing down a company by looking at their reliance on commodities. He tends to shy away from companies whose products are indistinguishable from those of their competitors, and those that rely solely on a commodity, such as oil and gas. If a company does not offer anything different from another firm within the same industry, Buffett sees little that sets the company apart. Any characteristic that is hard to replicate is what Buffett calls a company's economic moat or competitive advantage. The wider the moat, the tougher it is for a competitor to gain market share. Look at Apple, for example. They produce phones like thousands of other companies, but their software is how they establish their moat and maintain high market shares and profit margins. The final thing to look for is the crux of value investing, finding companies that have good fundamentals but that are trading below where they should be. The greater the discount, the more room for profitability. The goal for value investors like Buffett is to discover companies that are undervalued compared to their intrinsic value that they think that they're worth currently and will be in the future. An opportunity to buy at a discount exists when a company's current market value is cheaper than its intrinsic value. While there's no exact formula for calculating intrinsic value, You just have to look at a variety of factors, such as corporate governance and future earnings potential, to estimate intrinsic value of the share. Taking all that into consideration, also understand that Buffett is known as a buy and hold investor. He's not interested in selling stocks in the near term to realize capital gains. Rather, he chooses stocks that he believes offer good prospects for long-term growth. This leads to him to move focus away from what others are doing. Instead, he looks at whether a company is in a solid position to make money moving forward, and if its stock is sensibly priced when he wants to buy it. That's it for this video on how to invest like Warren Buffett. Let us know if you have any questions down below. The code for this video is Buffett20. Use it to gain 20 points on our site. If you have any recommendations for any new video ideas for investing for dummies, please let us also know in the comment section down below. Otherwise, thanks for watching. If you like this video, press like. If you like this type of content, subscribe to our channel. Give our site a visit if you want some free easy money. And with that, it's been PrizeDr signing out.